Hope everyone is good. Are you guys okay? Yes, 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 yes.
We are good. We are good. Good evening. How are you, President?
Yeah, I'm good. I'm good. I'm good. I'm good. It's a Thursday. It's almost the end of the week. Yeah. Um, yeah. Yeah, but it's been a very day today. That I can say. It's been a very good day. So I'm very much happy, and I'm just like, you know what? This week can end already. So I'm pretty much good. I'm pretty much like awesome. Okay. By session, we're just gonna be covering, our main focus is gonna be on the Fibonacci. Okay. Yes. Okay. Awesome. Awesome. Awesome stuff. Great stuff. Great stuff. Yo, weeks I had from my side, I had a very good Monday and I had a very good Tuesday. Wednesday was a bit hectic for my side, but today was pretty good. That I can say was pretty good. So tomorrow I don't think I'll be much active on the market, but otherwise, always be have a look at. I think also today you also some setup because it's before we jump into the session in terms of I always like to review economy because as much as we are trading, at least we should really have a bit of awareness, a bit of an awareness. And in terms of our economy today, I think the good thing about today, not necessarily today, but also by this week, we had a bit of a lesser hectic load shading. So it was on stage one. I think at some point we didn't have even load shading schedule, so which is good for economy. And we also saw, obviously the dollar, was not been doing so well. Good for our rand. We are ahead, and we also saw that there's a price. There's also, I think, petrol. There's also a drop in terms of the pricing of petrol, which is good for us. Otherwise, I'm looking at this economy, what's been happening today. The good news, obviously, is that we saw the Japanese GDP in terms of the first quarter. It came out positive. So when that is positive, we know that obviously the manufacturer is going to start picking up. The technology sector is going to start picking up, which is basically we're trading gold, and also those who are trading Nasdaq. So it's good for us. We're happy. And our current account of GDP in our country, we saw it came out positive, which is good. And even our GDP, obviously Euro, there were a lot of talks that the Euro is facing some sort of a recession. So a lot of people are talking about that. That was what also been moving the market. When you look in our country, it's on the positive 3.4 in the year of year, and then month on month, 0.5, which show that there's a growth in our production. But then I think what also moved the market today was the US jobless claims. It came out on a negative 237. So we can see that those numbers were not good. But tomorrow, I think the only economic event we have tomorrow is that is the one we only gonna be watching tomorrow is EcoCat. Hey, that really move, it does move the market. It's been like, it's just amazing. It's just like awkward that actually cared, okay, Friday of June. So that's the only event that I can say. Employment change, half a sue. We're gonna be looking at CAD. And it's funny enough that event that actually does move the market, and it's just like, yo, kind of strange, but it does move the market. Obviously, expecting that the CAD has been on the moving up, been like on the uptrend, but we're just gonna see how it goes. Otherwise, for tonight's session, it's not gonna be obviously gonna be looking at the chart, but mainly we're saying we're gonna be covering the Fibonacci. Is there anyone on this call who has used the Fibonacci before? If you have not used your Fibonacci before, you can just write on the chat box no. If you have used your Fibonacci before, you can write on the chat box yes. Just want to have a bit of a chance to know. If you have used it, just say yes, and you have not used it before, you can just say no. Okay. Perfect, perfect, perfect. I'm happy about that. Noel is saying no. Nubega is saying yes. Sizega, she's saying yes. Okay. Let's get those answers. You know, just write on the chat box you have. Tavis was saying yes. Okay, that's good. Oh, that's good. So everyone is basically, okay, most of the guys have used the Fibonacci. Okay, that's good. That's good. Okay, so now what we're gonna do tonight, we're gonna show you the way we incorporate the Fibonacci within the strategy. Okay, I think Togo is coming on. Yeah, welcome Togo. All right, it's gonna be good. It's gonna be good. It's gonna be good very soon. Okay, so tonight it's all about the Fibonacci. It's all about mastering the Fibonacci. Okay. Just a bit of a background. Fibonacci levels. What are the Fibonacci retracement level? So Fibonacci retracement level are basically lines of where a bit of the sound feedback. Let me just mute everyone. I think it's Mtogo just came on. Yeah. Yeah. I think that's sorted. Okay, so Fibonacci retracement, as the word suggests, retracement. Fibonacci obviously it's a pattern, it's a number. It's based on numbers. It's where when we use the Fibonacci, we use it number one to just to draw lines where support and resistance or demand or supply are more likely to occur. Okay. We also want to see number one, they are based on Fibonacci numbers. So each level of a Fibonacci is associated with a percentage. So a percentage is how much of a prior move the price has retraced. Meaning, for example, when you talk about the Fibonacci level of about 23.6% or 88.2% or 61.8%, it just means the price is retraced from there, move to that level of a percentage. Okay. So the indicators is useful because it has drawn between any two significant price points, such as the high and the low. The indicator then creates a level between those 2 points. For example, suppose the price, let's say you are selling something, an instrument is about 10 Rand. From the 10 Rand, it drops about 2 Rand 36 cents. In that case, obviously, it has retraced for about 23.6%, which is a Fibonacci number. Okay. So let's just go over the charts just to explain that a bit more. Okay. What can we use? I think we can use gold. I suppose we can use gold. Okay, TAT is coming on. Okay, we're just getting started. We are just getting started up in here. So I'm a bit excited. Get excited. Otherwise, let's just go have a look. Okay, so the first thing, obviously, should we use gold? Okay, I suppose we can use gold. Let me just change the template. Suppose what we do, the first thing we do when we're using a Fibonacci that I like to do, let's suppose we're gonna use this. Let's use this. Okay. We're first gonna mark this as this is basically the high, and this here is the low. Okay. Let me move this to this side. So now remember, if you're saying the price has been dropping from this level to that level, okay? And we take this level from this here as our level of drop, okay? If you can look at that, you can see this is 100%, okay? 61%, 50%, 88.2%, 23.3%, 16.8%, 11%, 5%, and 0%. Okay. So what happens here when the price has been dropping? Okay, dropping. Suppose it goes. Let's say we mark this level as the according to this Fibonacci. Obviously, if you don't know this level, I'll send you the settings. I think if you don't have the settings, I'll definitely send you the settings and just show you how to adjust. But all you do if you want to add these settings, obviously you go here and then you go Fibonacci properties and then you can click add. Then you can add it from there. Okay. The level of 16.8% is this level here. You just add 0.168 and you write it 16.8 and then you click add, okay? And then the 11 level percent, you add 0.11 and you just write 11 and then you click add. And then the 5% is just 0.05. You write on a level, and then you write number 5, then you click add. And then they'll be added right there on the Fibonacci. That is already there, okay? Okay, I just want to use maybe a perfect example. Maybe a perfect example, you'll be using something that is definitely moving up. You know, let's just use Euro USD. Okay. Okay. Suppose Euro USD has been moving up. Okay. Moving up from there to there. Okay. So this is what the low and this is what the high. Okay. When we talk about retracement, we are talking about a pullback. The price is pulling back from the original high. Okay. We're talking about the pullback. We talk about retracement. When we say 51% pullback, we are talking from this point to that point. There was a pullback. Let me just remove this. Okay. And then also remove this. Okay. So between 50 and 60 level. Okay. So the price always gonna pull back. Not just always. I'm just saying this is a high probability level where you see the price pulling back to those zones. So we mark this as a high and we mark this as a low. So the price pulling back between the 50 and the 60 level. And then what are we gonna do? We're gonna check left. Okay, when you're looking left, you are looking at this level. What is the price doing across here? Okay, what is the price giving us here? Firstly, we're getting this level, you know. Secondly, we are noticing this level. Obviously, when the price came back from that drop to this level, it just went below. When you're looking left, you can see this zone here. This is where you see AMA setup, almost set up like your head and shoulders, you know, those kind of a setup, maybe a swap zone, you know, that's the setup you would normally see. Then obviously we saw that setup coming back to this zone, then dropping, then further even drop. You can see that even that level is in between 38.2. Okay. But I think maybe let's first go over the slides and then we can move on to the session. Okay, can you see? So when the price actually touched this level, looking left, because the reason we're looking left, we're looking for the base, which is around here. We're looking for a certain pattern or candlesticks. Okay, the price came back to this level, and then it went to that level over there. And you can see that level is within the Fibonacci level, which is 38.2. It's also in line with the base. So this is the base. You can see that candle. There was a drop, black candle, drop, and then there was this base here. This base is made by a doji. Okay, a doji is just a candle. This candle is basically opposing the momentum, which means it's a base. If you go in a smaller time frame, you probably see more candles on this level. See, I think you can see right now there's more candles in that level. There's just a white candle showing this candle is opposite momentum, which means the market was dropping, then suddenly there was a pause. That pause is a base. Some people can call it a flag limit, but I call it a base. So the market dropped, came back, retested the base, then drop again, then come back, retest. Then on the obviously, even the retracement is also on the 50, between 60 and 61 levels. So that's basically why we use the Fibonacci. It's gonna mark these levels that are important, but we're always gonna use what? Price action to check. Okay, you're gonna be looking left, you know, because you wanna see where is this price reacting, you know, what is that level, you know. Okay, let's just go over the notes, you know, before we get into the grips of doing analysis using the Fibonacci. Okay, if you feel like, you know what, I'm a bit lost, please always feel free to ask a question. Okay, So, for example, I think this example is very nice. Suppose the price rises to 10 Rand and then drops to 2 Rand 36 cents. This means the price just dropped by this amount. Okay. So in that case, it has retraced by 23.6%. Okay. So that's basically why welcome Sandy Le, you know. And remember, there are about two zones that we're looking for. There is a mid trend zone. So the mid trend zone is between 50 and 61.8%. Okay, that's basically where we want to enter. Most of the time is obviously the retracement between the 50 and 61, and then there's an ending zone. The ending zone is basically between the 5% and 11% and the 16.8%. Okay. The mid trend zone is a trend mid zone where prices make a lot of stopover to look for liquidity before it goes ahead. Okay, it means the price is going to take a lot of stop losses, going to collect a lot of money before even moving back up. I think we saw this type of a pattern on Nasdaq, you know, made a drop and then went back up, you know, and then made another drop again. You know, that is what we call a mid trend. Okay. And then the ending trend, obviously, it's a trend edge zone where prices will change direction, which means if the price was going up, it tends to go down at the ending trend. And then obviously in terms, if the price was moving down, it tends to reverse up. Okay. So, and look for big liquidity before it change previous direction. So in this level, obviously ending trend is where you're gonna see your QML, your Quasimodo, is where you're gonna see your head and shoulders, you know, at that level, which is what level 5%, 11%, and 16.8%. But if you go to the percentage of about 50% and 11%, that is 50% and 61.8%. These are the levels whereby we're just looking for a retracement and the price go to the same direction as what before. So we measure these levels using the 5%, 11%, 16.8, and the 15, and the 61.8. Okay. So obviously remember, we use the level in the Fibonacci to find our entries. We also use them even for our take profits. Okay. So you just add the one. For those that are still new, I'll show you. For those who are just showing us, I'll definitely show you how to add the Fibonacci level once again. Maybe you can catch it on YouTube, okay? Yeah, but I think I'll show you before when we do the analysis, okay? So the first entry level, as we mentioned before, is between the 50 and the 61 Fibo. Obviously, this is already there on your MC4, okay? So this is where you're likely to get a midpoint, you know, where there's a lot of stop losses, a lot of liquidity. And you can see this basically after maybe the market has been dropping, then you see the market retracing. Okay, so price will make a retracement. This time, big traders will find in this level because in this zone, there are usually a lot of liquidity hidden. Then it goes back to the original trend. Okay, what this means? It means the market was dropping. And then let me just show you an example of this. So this is a zone. It's a very nice zone. Okay, let me just show you. This is about 50 and 61. Okay, an example. So this can be clear, you know. Okay, let's use another pair. You know, there are a lot of pairs here. Let's use another pair. Maybe you can suggest a pair, you know, if you're just joining us. Maybe you can suggest, like, you know what, Mr. President, please use this pair. I'm trading it. I'm gonna trade it. It happens. It does happen. So you're like, hey, I wanna watch this pair. What is going on in that pair? Okay. For example, this is what GDP USD MH4. Okay, it's a higher time frame. Okay, I always suggest if you are a day trader, obviously look at the higher time frame, and then look at the lower time frame for your entries, higher time frame for your direction. So we're gonna take that as a low, and we're gonna take that as this is a low. This here is our high. Okay, and this here is our please use NZ decade as well. Okay, you're gonna do that. Okay. Okay, this here is our low. Okay. Can you see the price was dropping, you know, the price was, okay, I think the lines are here. Yeah. The price has been what? On the downtrend, dropping, okay? And then suddenly the price started to reverse, from that, from this level, started to reverse. I think you've done analysis of this, that this was a bigger Quasimodo QML, which is here, okay? We've done analysis. I think we've done analysis even with dollar, because we highlighted that there was a S1, which is basically a support in that level, and it's amazing that when you do the analysis with price action, you can just make money while the price is dropping, and also make money when the price is actually going up, which is something that actually drew me to Forex. I went to a seminar and they were like, you know what, you can make money when this thing is going down, you can make money when this thing is going up. I'm like, what do you mean? Because in property, you only make money when the market is going up. And also my knowledge was that even in shares, if you're buying shares, you need to appreciate in value. Back in the days, I was like, yo, it's amazing. Okay, so if we've marked this, that actually this is a QML, so it's been dropping, and then now you see a break outside even within this channel. Let's just zoom in so we can use this example. Okay, so now from this, let's just remove that. So this is, zoom in once again. Yeah, okay, I think that's enough. Remove that. Okay, so now what I'm gonna do is, because this is what, a downtrend, so the market has been going down, it's been a downtrend. Okay, this reversal that you see is because the market has been what, on a downtrend. Okay, so now because this is going down, we're gonna take our Fibonacci, we're gonna take it from this level, oh, delete. We're gonna take it from the top, because it's a downtrend, and you're gonna put it there in the bottom. Okay, can you see? If you go and check, number one, what are we looking for? We're looking for, since the market has been moving up, retracing, this original move is what? Is going down. Is retracing, going back up by how much? 50%. Okay. If you go and mark, what are we marking? We're marking the 50 and the 61 level, which is this level here, right? This is what we call the middle. Okay, this is the middle of the zone. Okay, so this is our middle. Okay, so that you can understand the terms. And this here, this right here, we call it between the 5, the 5, 11, 7.8. This is where we call it at the end. Okay, so in the end is where we more likely to see what? In the end, more likely to see your QML, your head and shoulders, also your fake outs. Okay, if you are clueless about these terms, we'll definitely define them as we do analysis. Okay, so this is basically where you get a nice entry, very good entries for your sniper entries. Okay, so now let's go and check in the 50 and the 61 level. Can you see what is going on in there? What is going on in there? Can you see? We're gonna be looking left. Firstly, you can see there's a lot of traffic, a lot of traffic here. Okay, when the price dropped, the market created this base. Okay, this is a base. It dropped towards this level. It dropped towards that level, and you can see even that level is marked by what? 38.2. Okay, up now. Yeah, it's marked by 38.2. Okay, and then the middle of the zone you can see, but now I'm pretty sure it's gonna, okay, perfect. Now we are back in business, okay? Can you see this level is 38.2, right? We're going to the 50 level. You can see the market reacted in that zone. Firstly, it dropped, okay? So now it came back again. First, this was the first time. This is the second time. So now what do you have here? You have a lot of liquidity, right? You have a lot of liquidity. What is liquidity? It's your stop losses. It's your, okay, we're going to call it R1, you know, these levels. And we're going to call the other level R2, okay? R2, okay? So we're going to call this R2. We're going to call this R1, okay? This, what happened is the price, just show you what I mean. The price will be going up there, right? And then retrace towards the 50 level, and then go back again, and then continue with the drop, okay? This means, let me just show you what I mean. Let me just change this into line charts, okay? You can see the price drop towards this level, and then made a retracement between the 50 and the 60 level. This is the 50 and the 60 level. And then it dropped again towards the 16.8 level. And then the price went up there. So now you've got this zone, this side. You've got this zone, this side. So now what it can do, it can break on top of that. Why? To challenge that level over there, right? I hope this is making sense, you know. So we use the Fibonacci. It's gonna be like a guide for us, you know. It's gonna be like a guide for us. And you can see if you go on a bigger time frame, you can see this is almost like a very nice pattern, you know. Very nice pattern. Okay, come back, drop, come back, and then obviously what do we have here? You've got R1 and you got R2. So there's liquidity over there in the top, and there's also liquidity over there of stop losses and also of buying, of pending orders, your buy stops. A lot of people that were selling in this level because they were like, this is a strong resistance level. They've got their stop losses here. And some are breakout traders. They're saying, no, the market is going to break on top of this and we are buying it. And actually, if you go switch back to candlesticks, you'll see it touches those pins and then dropping, okay? Someone asked to use, okay, we're gonna use NZD on the next example. Where is NZD? Only we can find NZD. Okay. NZD, here you are. Okay. Okay. Okay, just switch. Okay. Let me just go over the slide once more. Okay. So remember, before we can use the Fibonacci, but also remember, we can also use what we know in terms of the price action candles, okay? Let's first go back to the slides so that everyone can be familiar with the slides. And I think I've shared this ebook with everyone so we can go through it together, okay? So now we've talked about the 50 and the 61 level. And then the second level entry is between 5 and 16 level. This level is need to be added manually, you know. I think we've done that. It is usually used when the price is at the end of the trend. So you normally see the setup patterns commonly, like for entry, like your Quasimodo. I think you've done that on the NICE in terms of the GDP USD, even on the Nasdaq. You see head and shoulder. You see the double or triple top, meaning the market is touching the same level 3 times or 2 times, okay? It's very nice also when you see this level when the market is just touching it for the first time. So we like it, okay? Our main purpose obviously is to see price action and basically where we're going to enter. And we want to have sharp entries, okay? So there are 2 market conditions to pull the Fibo. If the market is a downtrend, we pull Fibo from the high, you know, to the low. If the market is a rally trend, we pull the Fibo from the low. If the market is moving up, we pull it from the low. Let me just show you what I mean so that you will do the right thing. Okay. If the market is moving up, okay, that's how we do it. We pull it from this low towards that level. Okay. So now what are we gonna have? We're gonna have this level, the 50 and the 60 across here, right? And you can see the market made a reaction on 61 level, which is in line with this level on this side, because all is gonna look left. Remember, what you want as a trader, there's something called the confluence, confluence of triggers, which means a lot of things that are confirming one thing. That's basically what you want, confluence of triggers, okay? 51, and you can see even on the 38 level, can you see there's some reaction right there? And if you go and check again on the 5 and the level, you can see another nice trades, another nice entries. These are nice entries for pullback, and you can see in this level there's like nice pullbacks of your entries. When the market drops towards this level, market structure, retesting previous level and then continuing with a drop. Okay, retesting previous level, continuing with a drop. Okay, let's go back, smaller time frame. Okay, finish up with the slides before we go further in terms of analyzing NZCAT. I think the guys who are trading NZCAT now, they can see what is going on. Okay, I think they can see now what is really going on. Okay, continue with the slides. Yeah, okay. Suppose everyone is looking at the slides. Okay, so you know how to put it up now. Okay, this is an example how we do it. Okay, from the low trend, high trend, demand zone, we mark those zones basically our entries. Supply zone, we look for sell, pullback zone. Those are just important. Then we pull from the high to the low, and that's it. Okay, that is it. Okay, let's go over to the chart so everyone can see this. Okay, now let's first remove everything. Okay, I think let me start here. Okay, can you see the market has been dropping, it's been going up, from that NZCAT has been moving up towards that level. So this level here is our high, right? And this is our low, right? So this is our low. We're looking at the daily charts, okay? This is our low, right? So now the market has been doing what? Has been moving in some sort of a channel. But as it moving in this channel, what has been happening is been breaking, moving this channel. This is a bullish movement to the upside, and this is some sort of a retracement. People when the market get to this certain level, obviously here they're buying, they're selling, buying, selling. And let me just remove this so that when we're distracted by this channel. Now, suppose this is the high. When the market drops, it came back to what? To the 5 and 11%, right? So which means if you take this as a whole 100%, when the price dropped towards this level, it dropped up over 23.6%. That is a drop, okay? When it went back up, taking from the high, when it went back up, taking from the high, that means it dropped, taking that high towards this level, it dropped about 11%. This level is about 5%. Remember, Fibonacci is about numbers, but in this level, it's about the drop in the percentage of the instrument you are trading, whether it's a currency, whether it's metals like your gold, your silver, or whether it's NASDAQ. When you see the 5%, it means the price has dropped by 5%, 11%, 16.8%. You know how it is. If you are buying something and they're saying it's on the special, on promotion, you like 50% discount, 11% discount. That's why a lot of traders will be like, you know what? Right now, if the market is red and people are selling their shares, it's because the market is on a discount. What does it mean? It means the price have dropped by 50%, 61.8% from the original maybe bullish movement, maybe from the original highest price. Okay, so the price dropped 7%, and then it dropped again, retesting this base. Then this is the level, it any point two, and you can see if you're marking this as support and you're marking this also as this is your demand from the rally, base rally. So this is a demand zone. Again, you buying. The next test is about, this is basically your entry and this is your exit. Drop, break, again, come back, retest. This is your entry, this is your exit. This is again your entry and this is your take profit. Okay, and you can see in line with this base.